Recorded.
2025, from good to awesome. We've got the full year results and the annual release have been released to the NZX this morning, and this investor presentation is available on the NZX and it will be on our website today for everybody to see. So we'll start with the disclaimer. I will just remind everybody that nothing in this presentation constitutes legal, financial, tax, marital, or other advice. So please take that as read, and we will kick in with results. So today we're going to have our CEO and co-founder, Asantha Vijayaratne. He's going to talk us through the intro and the strategy, and then myself, Jamie Monaghan, CFO, and I'm going to talk to the financial results. So we will kick into it. Thank you.
Thanks, Jamie. Look, it's been a busy year, and it's been a pleasing year for us. We've continued to grow both in customer numbers, and you can see that's evident in the increase in processing fees, which is up 18% for the year. We've also been continually focused on the financial discipline as a business, and that's reflected in the EBITDA number of 1.4 million, which is up 27% year on year. And in the end, we're in the business of building a sustainable revenue stream, and that's reflected in the customer lifetime value, which is now sitting at 55 million, which is up 28% year on year. That's the asset that we're creating with the work that we're doing. And with that, despite the significant investments we've continued to make in research and development, which I will talk about a bit later on, we've managed to generate $518,000 of free cash flow. So from a highlights point of view, we've maintained profitability and substantially increased the free cash flow. We've accelerated the customer growth. So we've signed up more new customers in the last financial year compared to the previous. Again, that's as a result of concentrated work going into building that sales channel and fine-tuning the offering, and also supporting that for the first time with some brand work that we did. And we've increased the value of our existing customer base as a result of that. So that's the highlight stuff. Looking at the delivering on our strategy, a key reflection of what we do is about the relationship we have with our customers, and that's what we call loving our customers, and that's reflected back to us in the really high customer satisfaction numbers that you can see, and our ability for us to respond to a customer inquiry. It's one of the areas that we work really hard on. We got a lot of criticism as in our busy periods that there was delays in getting back. We're addressing all of that, and we're doing that in a more efficient manner. And you can see that coming through in the churn staying at or below the previous year's numbers, and the cost to serve continuing to drift down. So we're doing more with less, but not compromising on the customer care that we're delivering, which is really important. The second piece, which is around growth, we want to be known as a growth company, and that's really at the heart of what we are about. And we've seen that things like increasing our awareness translating into increased sales numbers, the relationships that we are building with accounting firms and other partners resulting in a higher referral flow. And one of the things that we've been working really hard on, which we'll deliver in the coming months, is a new website. Again, it's about taking the learnings of the last 10 years and saying, look, how can we do better, and how can we grow faster? One of the important pieces to remember is that currently the main focus has been around New Zealand, and it's about, while being in New Zealand, while being in this nice, cozy environment where we are well known, how can we build for scale? How can we build a multi-jurisdictional payroll solution that we can take to any country we choose to and sign up tens of thousands of customers and not break apart? That's a really important part of our thinking, and that's where some of the investment has been. So how do we build a scalable business that can take us 10x, 100x from where we are today? And that is, again, these are not easy things to do. These are hard things to do. And again, I'll cover some of these things in more detail as we get to the strategy down the road. I'll let Jamie take over now again and talk about the numbers of the last 12 months and some of the insights that you gain from that.
Super, thank you. So again, we published our result this morning. The key highlight numbers are on the screen for you. The net profit after tax does include some deferred tax asset adjustments, so we do have some credits coming into that. So I'm going to talk mainly to the net profit before tax, and you can see on that slide there that we have increased that from 190,000 to 460,000 before tax. And that profitability extends on from last year's profitability. So we did announce our maiden net profit last year, and we've continued to operate at a profitable level, which we continue to do and intend to continue to do it as well. Some of the key highlights on this slide, we are looking at our key measures are obviously our recurring revenue. The recurring revenue is made up of the two things: the processing fees that we earn from our customers, as well as the interest income that we earn on the float of funds that we hold on behalf of our customers. And that float continues to increase as the customer numbers increase. So those customer numbers coming through really benefit that revenue side, not just from the subscription revenue that we get, but from the interest income that we earn on that revenue as well, on that fund as well. Key to that, then, looking at the year-on-year comparisons, you can see that the processing fees have increased 18% year-on-year. Those are the funds that we've earned from those customers in the period. And the interest income has been a more modest increase at 6%. So those interest rates at the tail end of the previous financial year, they dropped off quite quickly, and the impact of that was banked into the interest income that we earned. A lot of that, those declining interest rates had been priced into the market. So the fixed term rates that we got for the term deposits had already been factored into those costs. The other one that, as Sandra alluded to earlier on, is that gross margin. So you can see there overall the recurring revenue has gone up 14%. Our gross margin has gone up 15%. So we'll go into the metrics behind this in a bit more detail shortly, but just shining a light on the fact that those operational efficiencies are coming through in that gross margin, and we have increased that gross margin percentage by 1 percentage point from 77 to 78%. Okay, going into looking at it a bit more over time. Our profitability there, we've looked at it, last year, as I said, we made our maiden net profit. We've extended that a little bit this year. The cash flow is very closely aligned with our profitability. So we're just over $500,000 of free cash flow. One of the key things for us is that free cash flow was used to settle at $650,000 debt that we had with BNZ. And that's, we're now debt free, which is a really solid position to come in. We've been looking for self-sufficiency from a cash perspective. We have, to ensure that we've got a little bit of buffer there, secured a $350,000 overdraft facility with BNZ, which we've not yet had the need to use, but it's there should we need it going forward. Okay, so going into a bit more detail on the revenue growth, you can see that revenue growth over time, and one of the key splits there is the processing fees and the interest income. So key message here is that the processing fee growth has remained fairly consistent. So that increase in the funds coming directly from our customers has increased over time. You can see the interest income relative to the total income has reduced this year. So we've managed to increase the interest income that we've had in dollar terms, but in relative terms, in terms of a contribution to our total revenue, it has decreased slightly. Going into the more micro metrics then, in terms of the key investment that we've made. So Sandra spoke to it earlier on, but one of the key things we've done is we've invested further into our sales and marketing capability. And we've taken that, historically we've been focused on investing on part of the marketing funnel that gets that direct attribution. We've lifted that up the marketing funnel. So, if you think about it from a brand awareness, looking at awareness, the interest, the desire, and the action, those 4 stages of the marketing funnel, we've moved that investment up, which means investing in brand awareness above the line to help more people know who we are and what we do. The attribution on that for the marketers in the room is more difficult to attribute, and it also takes a bit longer to see the benefit of those coming through. But that's a key contributor to those customer acquisitions costs increasing this year, as we have started that brand awareness investment in the cost up by 34% year on year. That said, it has been effective in terms of driving new customers. So a lot of the features that we've done, it's not one thing that contributes to the new customer growth coming in. There's a lot of different components, but in this component, we are talking about the acquisition costs. So as Asantha said earlier on, we've now acquired 1,755, which is up on the number of new customers that we acquired last year. Now that cost to acquire them has gone up as well as a result of those acquisition costs coming through, including that brand awareness investment. So our customer acquisition cost is now up at $584. And when we get to, I think at the bottom right of that slide, you can see that the long-term value to CAC ratio is 12 to 1. So what that means is for every dollar that we spend on acquiring a customer, we get $12 of value back from that customer. So it's a very, very efficient measure, and it's a common SaaS measure that we use to measure the effectiveness of the customers. Looking at the recurring revenue, then you can see there, the total ARR has increased year on year. It's gone up 6% from the annualized recurring revenue, up 14% year on year. So the annualized recurring revenue, remember, takes the position as at the end of March, the end of the financial year, and extrapolates that out by 12 months. A key component of that is the ARPU, the average revenue per user. So on a monthly basis, that's actually declined from $91 last year to $86 this year. Now, to break that split down into the processing fees and interest income, that equates to this year, it's $66 of processing fees and $20 of interest income. So the equivalent numbers last year were $65 of processing fees and $26 of interest income. So the amount of interest income per customer has actually reduced $6 year on year. And that's the key driver for that ARPU number coming down. From an overall business efficiency perspective, we've increased our headcount overall by 2, which is giving us an increased revenue per FTE of $187,000. Looking at the cost to serve, then, a key element within that is that headcount. None of those additional headcount went into our customer support team. The technical efficiencies that we've built in have meant that we have been able to maintain our customer support team at the level that they were at, with technical efficiencies, ensuring that we can handle the increased number of customers and maintaining that level of calls. And you can see that reflected in the bottom left there, where the cost to serve per customer has reduced from $21 to $19 per month. So a genuine reduction in that cost to serve those customers overall. I'll talk a bit more about the full customer lifetime value on the next slide in pictures. So this really is, for those of you who have been to this presentation before, you'll be familiar with this slide. This really is how we think about our business and how we measure our business and how we think about what we're actually providing to our customers. So the customer comes to PaySauce, we pay on average $584 to acquire them. So that cost, as I said before, has increased 15% year on year. We then receive generated the revenue from those customers, being $86, as I said before, being the processing fees and the interest coming through. We pay an amount of $19 to serve those customers. This is per customer per month, so a $19 cost gives us a margin that we make. And then we look at our churn rates. So our churn rates are how many customers leave us in any given month, and we look at that in percentage terms. And in the current financial reporting period, that churn rate has dropped to less than 1%, just under 1% there. So when you invert that, it gives you an implied customer lifetime value of just over 8 years. So when you put all those metrics together, it means that each customer is worth $6,747 to us, and you multiply that by the number of customers. And that gives an approximate value of our existing customer book of $55.3 million, which is our total customer lifetime value that we talk about. Now, without leading the witness too much, when you compare that to our market capitalization, our current market capitalization this morning was just under $23 million. So again, The existing customer book, using the standard SaaS metrics, which is not a perfect measure, but it is an indication of what our current customer is worth, is up at 55.3 million. Okay. So one of the key things that we look at then is, we spoke about the investment and increased investment going into our acquisition costs. So the sales and the marketing function has been a key investment that we've made. The other key investment we've made is into our product and development teams, ensuring that we focus on delivering a stronger product for the business. And you can see on the graph there, the investment has consistently increased. It's been a key focus area in terms of where we put the additional revenue that we're generating from the business back into the business. And I'll pass you back to Asantha to talk a bit more about that.
Cool. Thanks, Jamie. Just a couple of things just going through. It's really important to pay attention to a couple of numbers. So we've increased our revenue per FTE from $168,000 to $187,000, and that number has continued to grow, which is again a clear indication of us doing more with less, but not compromising on the customer care side. On the CAC, on the cost to acquire customers, while we've spent a little bit more than what we spent the previous year, we are buying a customer for 7 months of revenue. I'm incredibly proud of that. That is a result of a lot of hard work, and I know that is significantly better than a lot of the SaaS metrics that you see in terms of the time of revenue taken to acquire a customer. At 7 months puts us right at the top of that curve. So just looking deeper into the numbers, in round numbers, over the last 2 years, we've invested over $5 million in the R&D side. So we're building an asset. So why are we doing that? One of the learnings after being in this sector for 25 years is that one of the failings of the leadership of payroll companies is that they stay with the same payroll engine or the payroll solution for the lifetime that they're in business. And that means that you continue to incur technology debt. And it becomes harder and harder, and the repayments on that technology debt become harder on the business, which leaves very little room to innovate. We do not want to fall into that trap. We want to take the learnings that we've got and invest in today's technology. We started this business 10 years ago, which means that some of the technology we're using is now 10 years old. We're replacing that. We're transforming our business, but we're doing that at the same time as supporting the 8,500 customers we've already got. So that's a significant challenge. And I vividly remember Rod Drury talking about the migration of Xero when they went from Rackspace to the AWS cloud. He talked about rebuilding the plane while being there. That's exactly what we're doing. We've gone through that migration phase of going onto the AWS cloud very successfully, where all our solutions are running now. But also we're completely rebuilding the technology stack. And you've seen in the last year, we've built a brand new Gen 2 payroll engine. These are the assets that we are creating that will give us the firepower to get out of New Zealand to build a much stronger global business. And that takes time. That takes effort. There have been times dealing with older technology, and we hear of expressions of sticking lipstick on the pig. We don't want to be doing that. We want to start all over again, which is what we've done, from taking the learnings that we've got over time and then using that as an advantage. So in the last 10 years, we have AI now. It's taking all of those technologies and saying, look, what can we use now that will enable us to do the next 10 years better? And while doing that, we're responsible for over $2 billion of payroll each year now. We're responsible for 75,000 employees who depend on us to get their pay packet to them, to pay their bills, to look after their family. So we take that responsibility very seriously. So it is balancing the existing business that is feeding and funding us, but building for the future to go where we want to go, because our ambition has not been to be a small, regional, rural-focused payroll company. So that's a really, really important piece to understand in terms of where your money is gone over the last 2 years, and that is gone to build something that will enable us over the coming years to see really good results in terms of customer growth. So in terms of looking at the customer numbers, we've seen the pleasing part of last year is that we've increased customer numbers faster than we've done in the previous year as a result of investment. So, and we're doing this in a New Zealand market that is going through some of the toughest times. When I talk to small businesses out there, they're doing it really, really hard. And you know, if you are in New Zealand, you will know that it is not the best and the brightest time at the moment. It is a challenging economic climate. You've never heard us put that as an excuse as to why we haven't grown faster. Despite those tough conditions, we've grown really well. And I'm really pleased with that. So the other piece is that every time we add on 1,000 customers, we're taking that from a potential pool of 100,000 customers. So the pool that we can acquire customers is the same. Our share continues to improve. But so as a percentage, our growth rate looks like it's going backwards. It's not. So it is understanding that as our customer base increases and we continue to grow our numbers, we then come up with the question of saying, where are we going to find new growth? And that is a question that is occupying us as a board, us as a management team, of saying, look, where do we find the growth? If it's not here, where is it? And what can we do to access that? And that is the point where we are in the business, and we're looking at how do we use the new technology we've built? How do we use the 14 different jurisdictions that we are already in? And how can we leverage that to see us drive up growth again in the coming quarters and in the coming years? The advantage we have is we're doing this off an incredibly solid platform. We came to shareholders once in 2020 for money. We've not come back again. We've repaid debt. We've done this within the envelope of cash we have. So we've demonstrated to you that we are extraordinarily good stewards of money. And that enables us then to build a business. So when we require, if and when we require additional capital, we can demonstrate a strong track record of what we've done. We've got lenders prepared to lend money to us. And it's a question of where do we use that? What's the best use of it? And that's some of the things that we're looking at and going forward. So that very quickly is gives you an idea of where we are in terms of the year that's gone, and the year to come is a really important point in our evolution. And I'm really excited, along with the team, as we look at the opportunity ahead of us. It is hard not to get excited. It is like, from a strong point, we're not a startup. We are an established company with strong cash flows, with strong, loyal customer bases, which allows us now to step out and be brave and go after the market opportunity that exists in New Zealand and beyond. With that, I will take, I think we're going to questions now.
Yeah, so thank you to those of you who have sent questions through in advance. We have got Todd on the line who's curating those questions, and hopefully, Todd, if there's questions, you're there to ask us.
Thanks, Jamie. Yes, we've got a couple of questions here. The first one is from Zen Chen. Do you have any comments regarding your share price, which has dropped by 1/3 from its 6-month high?
Zen, I know you've been a shareholder for a long time, and you've been very patient. I'm really grateful for that. Look, none of us enjoy seeing the share price at where it is. And the cop-out answer from a lot of CEs is to say, look, I don't control that, so I can't do anything about that. But we do have some influence on that. And we've got to put our hand up and say, is maybe we haven't told our story the way it needs to be told, in a way that the market understands exactly who we are and what the opportunity ahead of us is. Currently, we're being judged as a small, regional, New Zealand-focused payroll business with a limited market, with a limited total addressable market. And because of that, we are worth whatever the market says it is. And it is up to us, if you disagree with that, to say why we should be differently valued. And part of that is our responsibility. And that's something that we're working on, is saying, look, we probably need to explain ourselves better in terms of where do we see ourselves going from today, and what have we built, which is why I've taken the time to explain where the $5 million of investment has gone. We have not seen the results of that investment as yet. We are really confident as a management team that we will. I hope that answers your question. So I hear this. You're not alone in asking this question, and people see and judge us as I said, a New Zealand-based payroll company that's just chugging along, doing modest growth of 10-15%, and that's what the numbers say, right? And that is where we are, and we're really cognizant of it. And I think as a board and as a management team, we'll be working harder in being more explicit and clearer in terms of our direction and what the size of those opportunities are. They are significant.
Thank you, Asantha. There's a related question here through from Rob Woodward. With the performance of the share price being heavily impacted by, amongst other things, low liquidity, small parcel trading through the Sharesies platform, can the directors outline the pros and cons of being listed, and what consideration they have had to take the company private again or get better analyst coverage?
Yeah, I think I sort of answered that in the first part. Rob, again, a long-time patient shareholder who came in on a seed round. Look, it is something that we're really cognizant of, and it is about the New Zealand capital markets is what's the best way of saying this? It has got inherent weaknesses for businesses like ours that has got significant potential, but currently is viewed as a micro cap, which means that we get no analyst coverage. Nobody really cares about us. In order to get to that, we need to get to 100 million. In order to get to 100 million, we need coverage. So how do we achieve that, and how do we get that balance? It is really difficult to get attention as the kind of business we are, with the opportunity we have, with the performance today. It is, you look at the numbers now and say, look, how can we change that? To answer your question about take private, there've been a number of discussions that we've had at board level, what our options are, and obviously that is one option. If the public markets are refusing to recognize our value, that is a path we can take. But no decisions have been made on that front. Like all things, it's an ongoing discussion we have, is to say, being listed as a public company, is that the best place for us? At this point in time, the decision is yes.
Thank you, Asantha. It's another question here through from Zen. As a software company, have you embedded the latest AI technology such as DeepSeek into your product? If not yet, why?
It's a really, really interesting question. AI is here, AI is real. We take it really, really seriously. We're not ignoring it. We're using AI in a number of areas of the business. The balancing point is, as I said before, 75,000 employees rely on us to safeguard their confidential private information that is incredibly valuable to them. We take that responsibility really seriously. We're responsible for paying around $200 million of payroll each month. And when you take that, the chance for us to staff up has got to be close as possible to zero. So in terms of using any new technology, we put that at the forefront. And we're currently working on a framework, a process of education and training for our staff to understand that side. So that's on the, how far do we go? On the other side, the easiest wins are being sought now, and they're being taken now. So which is on the customer facing side. So we've added, in round numbers, another 2,000 customers in the last 2 years. We've not increased the size of the customer support team. We've not done that by cutting back on customer care. We've increased customer care by using technologies like AI, where we can anticipate and answer questions better, faster, and more efficiently, rather than tying up a human. The idea is we use the human where only a human can deal and solve that problem. So we're using AI in that. We are a Salesforce user, and Salesforce is one of the pioneers around AI on that customer care side of things. So that's an area that we are deeply invested in. There's some great examples of where the AI technology can be really, really beneficial. A great story on that is 2 weeks ago, we were able to build a prototype of a brand new payroll solution of what that will look like. And we did that in a matter of days. Something that would have taken, we used a solution called Lovable, and something that could have taken, 6, 8, 10 weeks and tied up a couple of our devs' time. We did that in 48 hours. That's the power of AI. And I'm able to now take that prototype and show that to customers and say, is this what you're looking for? And they will say, I want this feature. I can come back, put that feature in, go back the next day. That kind of rapid prototyping, AI is brilliant for it. We love it. So we're using AI in a number of very specific areas, but it is something that we are really cognizant of, and we are very much on board of, and we're not ignoring.
Thank you, Asantha. There's another question here coming through from Matthew Chen. Are you still sponsoring sports teams?
Yes, we are. We're currently sponsoring the Wellington Lions and the Taranaki Bulls. We'll continue to do that. Our strength has always been in some of those grassroots. That's who our customers are. These are ordinary people doing ordinary things, taking their kids to the rugby, and that's the place that we want to be seen. It has been a really good partnership for us, and we will continue on that track because that's a place where our customers, people, hardworking business owners running the kinds of businesses that we support with 3, 4, 5 employees, those are things and areas that they go to, and we will continue doing that. We're not backing off on that. We'll continue to increase some of those things, if at all, rather than reduce.
Thank you, Asantha. Another question here through from Rob McIntyre. What are your international ambitions? And do you think you can self-fund it, or do you foresee the need to raise significant external funding in the next few years to service the growth?
I'll answer that question. It's really important to understand the founding of this business. We started this business not to be a New Zealand-based payroll company. I'd already done that. That's something that I've very successfully done, and a business that I sold to Datacom. The ambition from day one was to be a global business. And that ambition is as strong today as it was on the day of founding. We believe that we have the opportunity to become the micro business payroll globally. I'm really inspired by what Rod's done around accounting. There's no reason why we can't do the same for payroll. The opportunities are significant. For some interesting reason, New Zealand leads the world in a lot of technology related around payroll, which is fantastic, which means that we can incubate ideas and then we can learn from that before we go to markets that are probably a couple of steps behind in the evolution of payroll. So the answer to that question is a definite yes, because we're not interested in being just a New Zealand focused payroll company.
Thanks, Asantha. Question here through from Mike Mackay. New Zealand is a small market. You've looked at Australia in the past. Jamie, you were over there 2 years ago. Why has the offshore growth not been seriously targeted?
Yeah, in order to target the growth, you need to have the solution to get there. And that's what we've spent the last 24 months and the $5 million on, is building that payroll engine, using the knowledge we have we've been spending a lot of time in Australia in understanding what the requirement is and being 100% certain as you can possibly be as to what the product needs to be, what the market is, what is the part of the market, and that's work that we've continued to do.
Thank you, Samantha. Question here from Rob Woodward. If you've spent $5 million in rebuilding the payroll engine in the last year or so, what level of CapEx do you see over the next 2 years if you now have a new engine, acknowledging your comment on technical debt and new traditional payroll engines?
The work is predominantly done. A lot of the work happening now is around the front end. Sorry, I missed answering. I'll go back to the previous question. There was a question in terms of requiring capital. Again, at this point, we are not looking for new capital. Whether that will change as we see new opportunities and we require capital to do that, that is a question that we will deal with at that point. At this point in time, we've been able to self-fund predominantly all of the hard work required in building that platform, which, as we proved in the proof of concept delivery early on in the middle of last year, that's where we used that payroll engine for the first time. So that is pretty much working. What we need to now build is the front end and some of the connections and the integrations that go with it is what needs to be built. So again, we are confident that we can do it within the existing cash flows that we're generating via the business.
Awesome. Thank you, Samantha. No further questions have come through at this stage. All clear.
Thank you. Thank you for all of those who participated. Really appreciate your interest in our business. It is an exciting time, and it is a time of opportunity for this business, which we intend to seize with both hands. We've prepared for 10 years. We've done the hard work. It is now converting that to runs on the board, which is what you will judge us on. Thank you so much, and have an awesome day.